Hello, welcome to Dissident Canada. My name is Tyler. As I await, oh so patiently, the Fed rate cut decision for today, because I truly do think it is a Fed rate cut. It is likely. Um, well, this is all. It really all depends. Um, I would have a lean towards the 50 and then a 25 later on, because that's kind of what the labor market's data points to. But there's a massive institutional bias towards inflation in the Fed, so it could just be, a 25 basis point cut. I don't know yet, because I am recording it before that has come out, and you people know it before this iteration of me knows it. So, as I wait for that, I thought I would go and talk about the problems that are associated with getting governments to be fiscally responsible, because there are issues with it. People may not think there's no problems with it, but that's because they don't realize that governments don't operate on the same economic principles that individuals or corporations have to. And even corporations don't act on the same principles that, say, an individual has to be. Like, as an individual, you have to be relatively fiscally disciplined. There's only so much credit that you will be allotted before you are cut off. You are deemed too high risk. Now, you may still qualify for government backed stuff, but then you are, exacerbating the government lack of discipline. So it really then doesn't fall on you, it falls on the government. You you may or may not have been cut off from private credit before. Who knows? I don't know you. But it does cause problems, because bonds are, which that is government debt. Government debt is sold off in bonds, in which it is paid, in which, for you giving the government money, you are paid a percentage. Very simple. You're also paid yearly, typically bi-yearly. So twice a year, you get a check for owning a note saying the government still owes you. It's called the coupon payment. It's why government debt can spiral out of control very fast. But out of control and in the danger zone are two different things, as you can see by bond markets. Even now, this past week, the French bond market has experienced some screwiness, and the German bond market has also experienced some screwiness. But you did not have a failure to sell bonds. And that probably won't happen for a while. Like, to actually have a failed bond sale, a lot of things have to go wrong. Japan has had a few on the long end of the curve, but that's just because Japanese banks are waiting for the central bank to do some rate moves, so they're doing like weird buying up of the bond market themselves, the Bank of Japan. So they're just taking a breather. But anyways, like, you have to have serious fiscal, and it's not so much fiscal problems, it's economic problems in a country that lead to serious political problems. Hence why the French bond market only started being wonky after the president said, hey, we're going to get you out of there, and they replaced him, and there was like, there's no solution to the fiscal policy budget that we are trying to push. There's still no answer for that. Yeah, because France's economic situation is pretty effed, and their political situation is very effed. So that's when you start to get stuff go wonky, and you look at the U.S. bond market. Like, the number doesn't matter. You can go, like, I bring this up every so often. Go to U.S. Treasury yield curve after, say, 4 p.m., and you can get how the yield curve ended the day. And, right now, it's really freaking inverted. It looks like a spoon, not a curve that's supposed to go like this. I guess to you guys it would be like this. Anyways, the problem with government fiscal responsibility, and it's not so much it's a problem. Like, I'm an advocate for governments to be responsible because in the long run, you get a much better outcome. But there are drawbacks from transitioning from, being Keynesians into being believers in budget discipline. There are massive drawbacks. The biggest one is you completely F the banks and the economy in doing so. Why? Because the base layer of money, contrary to popular economic beliefs, it's really beliefs. It is not fiat currency so much it is bonds, specifically government bonds. Corporate debt as well, like corporate bonds, pretty good base layer, but not to the same extent as government bonds. Because government bonds are, if you're using the framework of Manmohan Singh, he's a IMF economist, and he has a fantastic phrase about things that act like money, and it is the moneyness of something. It is a fantastic phrase that gets you very far when you start asking the question, what is the moneyness of this thing? So if you ask that about bonds, you quickly realize that it is money plus, because again, you get a yield for owning it. The government pays you multiple times. Like, if you've got a 10-year bond, okay, you're getting 2 payments for 10 years. That's 20 years where you're getting, what is that? That's 1/12. That's 2/12 of, so that's 1/6, right? Yeah, that's how that works. Oh, well, we'll just go with 2/12. No, because I can divide by 2. Yeah, 1/6 of a yearly payout of, I don't know, let's say we'll go with the US 10-year, which is roughly 4%, 4.05-ish%. That's where it's been hovering around for the last couple of days. So we'll just use that number. So you get 1/6 of that 20 times. Plus, you get the big payout of the 4.05% plus all the money you put in. I mean, once you lock in, if you were to lock in like today, that's what you would get. That's pretty good. And especially for a bank, all right? When, you look here in Canada, or we'll look in the United States, depositors in the United States are getting paid like less than 1% for owning, for putting their money in a bank and holding it there. So if you make, let's just round up to 1%. The bank is pocketing like 3%, even though it's like closer to 4% on just holding a government bond. But that's not the issue that causes problems, all right? Where you run into problems is that because this is money plus with bonds, it's extremely safe and it's extremely liquid because governments kind of need to pay it back because they've set themselves up into a position where they have an extremely difficult time being fiscally disciplined, so they're just going to keep supplying these bonds, which means you have an ever-increasing amount of bonds, so you have an ever-increasing amount of collateral, and you can expect that as an ever-increasing amount of bonds are, created, there's an ever-increasing amount of money being flowed back to you as for holding the bond. This is where we get into bonds are used as collateral, meaning when a bank needs a loan of some variety, they will match up the term of that loan to the time duration of a bond. So you need a 5-year loan. You collateralize that with 5-year bonds. Very simple. Very, very good. Now that happens more than once per bond. The number I have found that seems to be the most reliable is each bond is used approximately 20 times. So each bond is backing up 20 loans. Now, if that sounds bad, it's because it is. When there's cash flow problems, basically. When velocity of money, the speed at which money is changing hands throughout the system, slows, you can no longer support that for very long. Which is why banks run into problems when money doesn't flow. But up until then, you get like a lot of money in the system and it moves, and it's pretty okay. When I say okay, I mean for these banks, it is an acceptable risk. It's a very acceptable risk when you realize that no government on earth is going to allow, massive amounts of bank failures, as proven in 2008. But that's the base layer of the current global monetary system. And you can section that out into individual countries. You can even section that out into individual, subsections in a country. Doesn't really matter. This is how banks operate. It's what they do. So by being fiscally disciplined as a government, you are cutting banks off from the safe, easy, extremely liquid collateral they need to produce the money that then circulates through the system. Now, it mostly gets sucked up into the financialized system, but it still, trickles in to the real economy where goods and services are produced. So if banks don't have that safe liquid instrument, they don't like to loan in current iteration of the financial system. Now, that won't, again, if everybody started being fiscally disciplined, all right, over time, banks would adjust to this system. But the problem is it would cause a lot of pain. And when I say pain, what do you think would happen if JP Morgan Chase as a bank looked shaky? Or Deutsche Bank? Or any number of the 1,000+ Eurodollar shadow banks that supply the liquidity that the system demands. What happens if the dominoes start to fall? Like, nobody really knows. We don't know how bad it could get. We have a bunch of economic theory and political theory where we can say, oh no 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 no, back the hell up. This is a bad freaking idea. But we don't actually know because it's never happened on this scale. Because the way you need to look at this is because the global financial system is so interconnected. All right, it's not like, oh hey, Canada falls, there's no contagion. Like, say all the Canadian banks fail. That problem doesn't just stay in Canada. That spills over everywhere because the way the system works is you get a little bit of exposure to everybody and everything. Especially, say, if you're a bank and you have to, for some reason, you're US bank and your primary clients are doing business in Canada for some odd reason. Okay. Well, you're going to need a supply of Canadian dollars. You're going to have to hedge on that. Or, because the Canadian dollar right now is, and by Canadian dollar, I don't mean the dollar, I mean the interest rates, because it's so much cheaper to borrow in Canadian dollars right now, US banks could come borrow in Canadian dollars and then take those Canadian dollars and go buy assets somewhere else in the world where you get more advantage. Like a better example would be, say, like Mexico. All right, Mexican banks can borrow in Canadian dollars, take those dollars, convert them to pesos, and then they've increased purchasing power, and now they can go buy a bunch of assets that will earn them a higher return than the what is right now minimum 2.5% borrowing costs. That is called a carry trade. That is also why the banking system is very interconnected. And if you were to, again, be fiscally disciplined, you create problems. Now, this is amplified for the United States because the United States is the US dollar bonds are, again, the global base currency. That is base money. I'm not. You want to say the dollar, fine, sure, but like, the dollar is just there to service dollar debt, and there's dollar debt because there's U.S. dollar government backed bonds. Like that. That's how that system works. So the base layer for the global monetary system is like 37 point whatever trillion dollars right now because of bonds. Because of U.S. government bonds, even though it's much, much higher than that because you have to add out everybody else's bonds. And then you have to do, well, we have to tier them on what's the rehypothecation rate for that country's bond, which is, then you're going into like you're grading bonds, and you peer into basically an abyss and try to detect that. But we'll just stick with roughly 20 times. So, no money. Again, U.S. or any real government that wants to be not run massive disciplines. You get, because you don't have a constant supply of money, and you get very little growth. Now, your trade-off is you probably have less. Prices would be probably more rock stable, but it's very similar to if you wanted to go back to the gold standard. You would have to make the trade-off of all the fancy stuff that everybody likes would become more expensive. The currency would gain purchasing power, but everything would be more expensive by, like, all the advanced technological stuff would be more expensive. So that would be the trade-off you would make. Is it worth it? Probably. Although I still think trying to find a system that is able to supply the amounts of currency demanded at any one given time frame is a much superior way to work, and you'd have to have a decentralized system to do that. Because, like, if you break down and you look at a country scale, all right, the needs, like, if you're looking at the monetary needs, like the currency, the circulation of currency that is needed in, say, southern Ontario versus, the Yukon, is much higher. So if we were working off southern Ontario numbers, okay, the Yukon would experience more money than there is productivity, and you would get inflation. And if we were working off of Yukon numbers, southern Ontario would experience extreme deflation and be in a depressionary state with very minimal growth. So when I say decentralized, I mean you have to have multiple different currencies in localized regions to even attempt to have a fundamental system. Now, you could potentially have a hypervisor type deal going on, which would just be an intermediary currency from swapping between the two, or between the multiple currencies that you would need in just, say, a country. Because, again, like, I'm just thinking of, like, the Yukon, but, like, think of economic activity in, say, St. John's. That is radically different and less than the economic activity around, say, the oil sands. Or, like, Mennonite country by me. Very different economic activity. Very different economic needs. But, in the current system, everything's got backed by government debt. So you remove the government debt, you run into severe problems. One example I can give you is from George Gammon's Rebel Capitalist Interviews, I think is the channel he has, or it might be just Rebel Capital. Is it just Rebel Interviews? I don't know what the channel's called. But he had a buddy of his on who is, or was, in the primary dealer banking world, which means basically the guys who go to the government who get first dibs on bond auctions, all right? Very important to the financial system. And he brought up the fact that under Clinton and the beginning of the Bush years, all right, Clinton was running, like, there was a U.S. budget surplus of very minimal. It was 3%. So there was an extreme problem with liquidity, and there would be in the future, because it's not just an immediate problem now. If government debt stalls, that means it stalls going forward, because the way government debt works is you consistently roll it over. So if you make the government comes up with, hey, we need $6 billion right the frick now, okay? They issue bonds mostly towards, say, the 1 month, because they can sell that real quick and easy, and, trailing down. But as time goes on, you start kicking all that 1 month. Some of it you re-up as 1 month, but then it comes 2, 4, and so on and so forth. And the debt propagates down the line. So what happens is, as that supply makes it to markets, banks adjust their lending practices based on supply. So if you've got, you know, a lot of short-term bonds, you have a lot of short-term loans. You have a lot of long-term bonds, you have a lot of long-term loans because you are matching up bonds and loans. It's how bank works. So he goes through, and it's like, well, this likely led to the issues of, you know, there was a small recession in the early 90s. Then you had the dot-com bubble, and then you also had problems in 2008. Now, I'm not saying that the fiscal responsibility caused those issues, and I don't think he was either. I have to rewatch it because there's so much good information in that episode. I'm going to probably try and find it and link it down below because it is, again, one of those things that I think people should watch and rewatch because so much information was given out. But it is a contributing factor. Like, if you look at 2008, there was a lot of problems going on. And there's no just root, like, again, I mean, the root cause is the Eurodollar system, but, like, there was no mainstream root cause that could cause it all. So, now, eventually, in the long run, you'll end up in a system that is better. Banks aren't just, you know, pocketing easy spreads. They are forced to invest in the real economy, so people will have, in the long run, a better life and better, most likely. You'd get rid of the wealth siphon that I talk about with government debt, where it's a double whammy. Like, you have the government using a large percentage of money, which is just, they're not able at any level of government to do that effectively, so you're basically wasting capital. But also, you know, you just have banks just pocketing the spread of deposits versus bond yields. So, like, you make more and more money by doing nothing, and then you can rehypothecate that again, doing nothing. Basically, you just say, yeah, you get a bond, 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 and it's all the same bond. And because it's all technically, like, it's loans and repo, so they get, you know, they get to use it as collateral, but you're getting paid back. So it's a really good scam. Really good scam. And it creates the vast majority of money. Again, if you do not believe me on people that banks create most of the money, go look at M0, compare that to M2. Go to, if you're Canadian or if you're not Canadian, because it applies to basically everything. Go look at M0 money statistics, because that's basically just all government minted. Now, they do throw in short-term government debt in there, so who actually knows how much currency is floating around? But basically, M0 is currency plus short-term government debt. You can expand it to M1 if you want and compare that to M2. M2 is usually always double M1 at the very least, if not greater. And there's expanded money statistics. Like, if you're in the United States, it goes, I forget how high it goes. I know there's an M4. I think they went to M6. It's just ridiculously high. And if you can find the aggregate data, like, I know, for example, the Bank of Canada has what is formally, is it E1? You just search for Bank of Canada money aggregates and you'll find the chart. And if you read the charts, you can see, oh, this is debt-based, 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 the vast majority of this money is debt-based, which means it came into creation because of banks, not because of government. So, if banks don't have a financial instrument to loan against, you ain't got the debt or the currency units to supply the economy. Again, I think it's worth the problem, and a slow wind down is much better than a fast wind down. But again, either way you do it, you are going to run into problems. It's why I do not take most libertarians seriously when they say, yes, we must lower the government debt. All will be good. Once we do this, everything will be sunshine, rainbows, and unicorns all over the country. No, it won't. You don't understand the way banks operate and have operated for a very long time, and how they do not like risk. They are risk intolerant unless you force them to be. Like, even the scheme of bond rehypothecation, okay, that I was talking about, which, again, just using bonds multiple times as collateral, or a single bond as multiple times for as collateral, okay, that works really, really well. I mean, up until it doesn't. Like, eventually you're going to run into a problem. Everything has a problem at some point. But up until then, you've got money like there's no tomorrow, and it's flowing, and it's great, and you're making bank. Which is why it's always better to be the primary dealer bank than anybody else, because the bond is on, no matter where it's being rehypothecated, it's in your possession. So, like, if things go wrong, you're the one in control of the base layer, so you're safe for the most part. But again, if you run into a problem in a system, in a monetary system where there is no safe liquid asset for the primary dealer banks, and stuff goes wrong, you go from the big banking stability that you want into, I don't know if any of you remember 2008, but there was serious questions about if most banks were going to survive, at least in the United States context. There were worries. People were stressed the hell out about that because banks is important. Although we may be moving into a system where they're less important because of, say, cryptocurrency, but that is a wildly different topic. I hope I was able to at least explain in some amount of detail why fiscal discipline is a massive trade-off that comes with a lot of dangers and problems and issues that would need to be fixed relatively quickly, but couldn't be fixed relatively quickly. Again, I still think it's worth the risk. I think it needs to be done because of the wealth siphon effect. It is destroying the middle class, and you basically have a return to feudalist economic principles, which is not great. And it is so subpar. But it's what's going on. Until tomorrow, have a good day.